Hi. So I wanted to talk a little bit more about Ulta Beauty. I think my last video did cover some of the quantitative reasons why it wouldn't be a good investment. But in this video, I just wanted to finish it off by talking about some of the qualitative reasons why it could be a good investment. And if not, an intelligent speculation. So, just to differentiate between those two terms, between what an investment is and what a speculation is. A speculation would be something like this. I look at Nvidia stock and I see that in the past year or so, it's gone up 176%. In the past 5 years, whoa, it's gone up 3,000%. So I would buy it because, people are buying the stock and I want to ride the wave, so to speak. That's one example of speculation because it's kind of like going to the horse races. You're completely betting on the fact that people are going to continue this amazing bull run, regardless of their financials. It would be, comparable to taking part in the dot-com bubble or the Great Depression upswing, the Roaring Twenties, because, you're looking at the stock not for what its intrinsic value is using past performance, but maybe what its future holds, and you're betting that its future is going to justify your purchase. By buying Nvidia at this point, an investor is saying that its current products and services that it offers and the company that it is going to grow significantly in the future to justify a $3.2 trillion or more market cap. Um, Now, just a side note, that is a very, very risky idea. If you want to base an investment, your own money, on the future success or something that will happen in the future, you have to admit that is taking on a lot of risk because no one knows what's going to happen to the stock price in the short term. No one knows, even in the long term, no one knows for sure, and no one knows what's going to happen to the company's earnings, what's going to happen to the economy, and all of the possible scenarios and contingencies are things that you have to guard against as an investor. And that's where the investment comes in, because an investment, to bring up Ulta Beauty again, is one where the stock price is at an extreme discount to where the intrinsic value is. Say the intrinsic value is 500 a share versus its current 377. And that big buffer between 500 and 377 is very important because that protects you against wars, epidemics, company disappointments, things that don't adversely or permanently affect the company, like macroeconomic events and things like that. There's an endless list, and if you saw the video with me looking through the annual statement, there were many mentions in the risk factors of, all sorts of disasters that can happen. So, in short, to guard against that you have to buy a stock at an extreme discount compared to its intrinsic value. You're not buying a stock because other people recently bought it up and it's going up. You're not buying a stock because it has some product that you believe is going to change the world, because you have no idea. You're buying the stock because it's at a 30 to 50% margin from its current price to where its intrinsic value is. And, the obvious question is, how do you assess intrinsic value? It's easier said than done, but something that I'm learning as as I've just finished, by the way, this 700-page investment textbook, and I've listened to a lot of Buffett's Berkshire Hathaway meetings and Munger's, of course, that it's not just about the quantitative reasons that makes a security undervalued. you can't get too hung up on the PE ratios or the earnings yields or the current ratios and things like that. You have to combine that with a good sense of what the qualitative um, what the qualitative aspects are. And the qualitative aspects include the size, the growth, the stability, how the management returns shareholder value via dividends or repurchases or investing into growing the brand. Um, and those are things that you can consider. And if they are good, then that is a reason to pay an extra price. For instance, in Ulta Beauty, the price has gone up 17% in the past week because of Berkshire Hathaway's purchase of it. People follow Berkshire Hathaway's purchases. Everything that they make has to be publicized, so that's why. And, that's something that made me a little bit cautious because that means that's 17% less undervalued, technically. But when I'm thinking about it, this company has such a big foothold in the cosmetics industry. It's $18 billion market cap, but nonetheless, it has a large market share in retail, and that's just by its stores and its popularity. Its larger stores, and revenue as well. And, it has a competitor, Sephora, which doesn't have publicized financial statements. But other than that, Ulta Beauty is kind of its own animal. There's not a lot of competitors that can boast the same types of product diversification and selection for their customers. And that, coupled with the fact that management has been very friendly to shareholders, which is something that Warren Buffett has always sought after in companies, seeing that, are they companies which return value to shareholders via dividends, repurchases, investment to the brand. And Ulta Beauty is definitely an example of that. Spending $1 billion a year, which is, I showed 2 videos ago on this, that the company spends $1 billion a year on repurchases is a very good sign that they are shareholder friendly. That holding these shares is very positive because each value of that share will increase. That's the goal, at least. And the final reason, so just to wrap it up, the final reason that I think Ulta Beauty may be actually an investment, that maybe it is justified to pay more for this company because of its qualitative reasons, is that the shareholder equity versus the earnings, as well as the invested capital versus the earnings, is a very low number, which means it takes a very small amount of assets and liabilities and money, capital, to make money. And that is very, very significant, especially in times that we were heading into a possible recession. I'm not predicting the future, but it's possible. It makes the company recession resistant because they don't require a lot of capital. They don't require a lot of liquidity. So the significance of that, the earnings over the shareholder equity and invested capital. Invested capital, just really quickly, is a function of shareholder earnings plus long-term debt. That number being so high at about 56% versus the average, which you'll see in the retail industry, of between 10 and 30%, is a very significant qualitative factor in favor of Ulta Beauty. So finally, to wrap it up with the numbers, I talked a little bit about last time, the earnings yields and things like that. If we were to take the current earnings, which is $26 per share, 26, and the PE ratio is a number that you'd multiply against the earnings per share to get the estimated price, to get a price. Because it's just by simple division. The earnings per share, earnings over shares, times price over earnings means that you're getting the price per share because the earnings cancel out. They cross cancel. Anyways, not to get too technical, but if you were to apply a PE ratio that was a little bit less conservative, last time I was running 12 and 15 and showing that this is not undervalued by any means, 390 versus 377. That's not a significant margin of safety. However, if you were to go up to, let's say, 20, because of the factors that I mentioned, like size, the seasonality of the business, the stability and the growth over the long period of time, the return of shareholder value via repurchases, and the capital lightness, the amount of capital that they need to earn is low. Because of those factors, paying an extra price of 20, especially in an environment where 20 PE ratio is not something that is too high at all, you get $520 per share. And at 377, if you found the appreciation potential, you're looking at a 38% difference between price and value, and 38% does fall in a margin of safety. And the other factor is earnings. Is 26 the right number to use? Should you use the most current earnings? That is on a case-by-case basis. Earnings can drop, earnings can plateau or grow. You have no clue. And anyone who tells you they do is lying to you, even the analysts. But 26, if I were to use current earnings, that's what you'd get. If I reduced it to, let's say, 20, you'd still get $400 per share, which is over the 377. And the scenario where it drops to 20 is definitely possible, but the probability that will jump back again to normal earnings levels, high earnings levels that it has been, is high as well. I mean, COVID saw a huge crunch down to about $176 million made in 2021 net income wise at a earnings per share of 3.1, very low. But they recovered instantly to 2022. They actually made progress between 2020 and 2022, as if 2021 was just a normal year of growth. They went from 12.4 to 18.6 earnings per share. So this company shows an ability to bounce back during recessions, and that's a symptom of how it has this capital light business model. So it depends on who's watching this. I think if you feel that you can take on a little bit more risk and you like to consider the qualitative as well as the cold balance sheet, cold income statement numbers, then I think Ulta Beauty is a good investment. If not, you could call it an intelligent speculation. But I think my last video is still correct. At the same time, the PE ratios are high. The earnings yield is not that impressive. I mean, you can still get, even if we assume it's 26 times 20 and we get to this number, your earnings yield is only going to be $7.25%, and you can get a risk-free bond for 5%. It's up to you at this point. Falling interest rates may change the sentiment of a 7.25% earnings yield, and I leave it up to you. So just some education there as well to know, and I hope you enjoyed that video.